Hi, my name is Roy Rumbough, and I'm a professor of accounting at the University of North Texas in Denton, Texas. I started teaching in 2017 after a long accounting career. I worked in one of the big four accounting firms in New York City doing audits of large companies. Went on to work for Maytag for 17 years. There, I started in internal audit, then went into financial planning and analysis, and was named the vice president of finance for a division up in Burlington, Vermont, where I stayed for about 4 years, and then was named the chief accounting officer for Maytag. But ultimately Maytag was sold to Whirlpool, and so I was chief accounting officer there for 4 years. Had to find another job. Ended up down in Texas with Lennox International, and I was chief accounting officer there for 11 years. So yeah, I've done about everything in accounting. But in 2017, I decided, hey, it's time to give back. And so came back in to teach students about accounting, business students, and the principles of accounting course. And I also taught and teach intermediate accounting there. So mentored a lot of students, been a great experience for me. Then, of course, along came the coronavirus, and I had to learn how to do all this stuff online. I guess they say you can't teach an old dog new tricks, but I did learn how to do it. And so I've put all my lectures out on YouTube. Hopefully other people in other universities, if they find them useful, hopefully they'll be able to use them. So I bring my own personal style to the course and bring some business experience in here and there. So with that, I'm going to share my screen and get started here as an introductory lecture to principles of accounting. Thank you. If I can figure this out, there we go. Here we go, right here. And let's start this out here. So, principles of accounting. Now, by the way, that's a mountain in Texas, of all places, and Guadalupe National Park. It's a beautiful mountain, and I've hiked that with my son many times. So it's a great place to go out. It's right below Carlsbad, New Mexico. It's about 40 or 50 miles south of Carlsbad. If you go there, bring plenty of, make sure your car is full of gas, because there is nothing around there. So let's start with accounting here. And I think a lot of people are intimidated by accounting. And, accounting, we're going to reflect the business itself. And so we're going to get into it in a minute here. We're going to measure and report business. So I always start all my classes out with, hey, what is the business cycle? What's the, let's say, put yourself in the shoes of someone who wants to start a business. And I would like you to pause for a minute and think, what is the very first thing you need to start a business? Think about that for a second. Now, it takes a lot of my students' time to come up with the first thing you need, because a lot of people think, well, I need money, I need all these other things, maybe I need a building, maybe I need people. Well, the first thing you have to need is an idea. You've got to have an idea that nobody has ever thought of before. And it's an idea, and maybe they've thought of it, but they haven't thought about a way to make money off of the idea. And so you need a great idea that could be commercialized and that you could make money. Who would have thought way back when Mark Zuckerberg was sitting in his Harvard dorm room and created this small networking app called Facebook, and it was only for Harvard students. And then it was only for Ivy League students. And then it was only for students across the country. And now look, everybody's on Facebook, and he is a multi-billionaire. And so that was the idea that he was able to commercialize. Maybe some other people had similar ideas, but he's the one who could take it all the way to Bright. And so now once you have the idea, and even Mark Zuckerberg, he needed servers and everything else. So you've got to come up with cash. So where are you going to get cash? There's number one, you can let people buy an ownership interest in the company. We call that equity. And if you watch Shark Tank on CNBC and you see Mark Cuban and some of those guys there, people are pitching ideas to them. they all want equity, meaning they get some influence over the business. And if the business takes off, they have an ownership interest in all the future earnings of that company, and they have control. Now, what do they receive back? Well, hopefully, if the company grows, the value of the company will grow, and the value of their equity position will grow. That would be if you look at stock prices on the New York Stock Exchange. When those stock prices go up, means the value of those companies gone up, and that's called a capital gain. A win for the shareholders when the stock price goes up. There's always risk that the price could go down also. And then also along the way, companies have the option to pay dividends back to. They do not have to pay dividends, but they can pay dividends. So that's one way of getting funding and getting cash. A second way is that you can borrow money. Now, a lot of entrepreneurs, they would much rather borrow money, even though there's a risk, because when you borrow money and you're using someone else's money, interest is a cost of using someone else's money. For banks, they're making money. You're using their money, they get interest income. But for companies, we have an interest expense. If we don't pay, unlike dividends, if we don't pay this interest back, they can come in and we would have to declare bankruptcy, and they would take over all of the assets of the company. So this can be risky, but here's the positive side of debt. Let's say you have like Mark Zuckerberg may needed $100,000, just use an extreme example, and it turned into $100 million, and you just borrowed $100,000. Guess what? I've only got to pay back $100,000. All that left over, 99 million or whatever, 99,900,000, that's left for the one owner. And so debt is good for owners because the debt holders, as long as we pay our interest and pay our principal back, we get to keep the remainder. So debt holders, as I would say, don't have skin in the game. Equity holders have skin in the game, and they have a right to all their proportion of ownership. They have that same proportion ownership in all the future earnings. So if that $100,000 equity investment became worth $100 million, they get the whole $100 million, and their value grows. And so this is all about, when you take a finance course, what percentage should a company have in equity capitalization versus debt capitalization? A lot of finance courses around this, and it's pretty interesting. So once we have cash, we're going to go recruit people. We need people, managers, whatever business we have. If we're making a product, we got to have manufacturing people to make that product. We may have to have warehouse people. There's a lot of different things we're going to need. And we have to get facilities and equipment. And I use this as a manufacturing company. We're going to produce inventory, manufacture inventory. We've got to pay for that inventory, so this cash, right now we're just using up a lot of cash all the way around this first loop in the business cycle. And so we've got to start making money somewhere. So hopefully producing the inventory and paying for the inventory we do that at the lowest possible cost. And then we sell the inventory at the highest possible price. Whoops, wrong way here. Therefore, we make money. Now, when we sell inventory, a lot of times we sell it on account, meaning that people don't pay us right away. They will pay us later. This is how business operates. By the way, we might have bought inventory on account too, sometimes harder for a new company, but we'll buy inventory on account, meaning we'll pay them later. That's called accounts payable. That's what we call a liability. We owe people money for the inventory if we don't pay them right away. That's an accounts payable. However, when we sell inventory or provide services to our customers and they're going to pay us later, we have an asset. It's called an accounts receivable. We have a legal right to collect money in the future from those customers. And so there we're going to go collect the accounts receivable. And guess what? We've made the full circle back to cash. And hopefully we're going to end with more cash than we started with. And then we, at a minimum, want to pay interest on the debt. And if we have some leftover money, usually hard for a first-year company, we may declare dividends and pay some dividends to our equity holders. So this is the circle of business transactions that is happening continuously every day, every minute. Now we have multi-global companies doing transactions real time all over the world, and they're just continually doing business. And so what the accounting goal is to take a snapshot of all these transactions that are taking place and measure the results. And so that's what accounting is about. So when you think about principles of accounting, we're going to touch a whole multitude of aspects of business that you may not know about as a new business student taking an entry-level accounting course. But there's a lot of transactions here, and in accounting, we've got to measure those transactions. So what is accounting? You'll hear from me throughout that accounting is two things. It's number one, a measurement system right here. Number two, it's a reporting system. So we're going to measure things. And by the way, I love to say this, it's not complicated math. At the University of North Texas, calculus is a prerequisite for taking the first entry-level accounting course. So I always ask my students, hey, have you guys taken calculus? And everybody raises it, yes, we've taken calculus. And they're all excited. And I say, well, guess what? It's completely 100% irrelevant. We're never going to do calculus in accounting. And that's great for people like me. I'm not that super smart, but I can get accounting. Accounting is not going to be hard math. Who knows why calculus is usually required in front of an accounting course? I guess just to make sure you know how to work hard and figure stuff out. Because in this class, you are going to have to work hard and you're going to have to figure things out. But it is not a math course. I have a lot of students who say, man, I'm really good at math. I made an A+ in calculus. Why am I struggling in this class? I don't get it. I said, guess what? Not a math class. That's why. This is accounting. It's logic. So you're going to have to think through this logic. Once you understand the logic, it's kind of like riding a bike. You get it. And there's a lot of students who get it. It's like a big puzzle that all fits together. And so that's what makes it interesting. There are rules and principles that we apply. They're called GAAP, which stands for Generally Accepted Accounting Principles. We have in the U.S., we have a board, the Financial Accounting Standards Board. It's a big organization that creates generally accepted accounting principles, and we call that the codification. Whole bunch of rules. I mean, I'm talking about 3 or 4 books, like 3 or 4 inches thick each, that go through all the rules to count for all the varied and the sundry kind of transactions that you see in business. And business is getting more complicated these days with derivatives and pensions, share-based compensation for executives. There's a lot of complex transactions that are taking place. So accounting has had to been able to measure those transactions. But it's not just a measurement system. We're measuring with a purpose. It's also a reporting system, because we've got to report back out to those debt holders and equity owners. How did the business do? Is the business making money? If you invest in your money, your precious hard-earned money, into a business, you're going to know, hey, after the year or maybe even after a month, hey, how are we doing? Are you guys, what did you do with my money? How's it going? Well, that's what accounting is about. We're going to measure, then we're going to report back. We have special methods to report back how the business is doing. Is it making money? However, also, we want to know a second important question. What's the financial status of the company? Are there big debts? What's the viability of this company long term? Maybe they have a great idea. Maybe they even made money in their first year, but they have big debts and big interest payments that could, in the short term, overwhelm the business. So we want to know, does the company have the resources and the cash to continue operating? So we're going to measure transactions, and then we're going to compile all those measurements, and then we're going to report out. is the business making money? What is the financial status of the company? And those are the two main questions that we're going to try to answer. So what do we measure? Well, guess what? We're going to measure assets. That's things we own. That could be cash. We talked about accounts receivable. That's where people we've sold to owe us money. We may have purchased inventory and buildings. Assets are all the things that we own as a business. Second thing, second two things are liabilities and equity, and those are going to be the claims against those assets. So liabilities are amounts that we owe other companies or maybe even people, things like accounts payable. So we may buy inventory on account, just like we sell inventory on account. And so we may buy that and receive the product that we wanted to buy, but we will pay for it at a later date. And so therefore we call that a liability. We owe money for whatever we receive, and that's called an accounts payable. Oh, sorry about that. By the way, many of you, I'm sure, work, and guess what? We don't get paid right away. I don't get paid right away. You work, and then 1 or 2 weeks later, you get your paycheck, because it takes company time to compile all the hours you work, the pay rate, all the withholdings that they take out for the governments and everything else. So it takes time. So companies will receive the benefits of people working for them, but at any point in time, they will owe those employees for the work that's been performed. That's called what we call salaries payable. By the way, anytime you see the word payable around something, think liability. That's a liability. That's an amount the company owns. If you see the word receivable, like accounts receivable, that's an asset. We have a right to collect money. Accounts receivable, notes receivable would be an asset. Payable items are liabilities. Guess what? If we cannot pay our liabilities, then we're going to be bankrupt. So it's very important that we measure and report how much we owe. What are all the amounts that we owe, so that investors and interested parties in the company can understand what are the liabilities of the company. And finally, the leftover piece is the owner's interest. It could be common stock, preferred stock, a partnership rights. It could be different forms of ownership, but the equity is the third piece that we measure, and it's the how much. It's really assets minus liabilities. The leftover piece is equity, the owner's piece, and we're going to talk about that here in a minute. All right, here is where we lose people. Right here, we lose people. We should not lose people for this, but we do. And it's, how do we measure? Well, we use these things called debits and credits. And right there, people think, oh my God, I cannot do accounting. This is too complicated. It is not complicated. And I'm going to see if I can pull up. Well, I'll do that later. The word debit, by the way, comes from, I believe it's Latin or Greek, maybe Latin. And it comes from a word called debitare, which means the left side. Credit comes from a word called creditare. It means the right side. And we'll see in a minute, if you line up all of your assets on the left side, those are all a normal balance of debits. And then on the right side are all the claims against those assets, liabilities, and equity. Those have credit balances. That's where the word debit and credit comes from. So anytime we put an amount, a debit into an account, an asset account, that asset account increases. So if we receive cash, we will record a debit to cash. If we pay cash, we have to cut a check to our employees, and our cash declines from our bank because we cut a check and paid someone. That is a credit to cash. Now, on the opposite side, on the right side of the balance sheet, liabilities and owner equity, a credit increases a liability or it increases an equity account, where a debit decreases a liability or an equity. What's an example? If we have a salaries payable, that's going to have a credit balance. Well, guess what? What if we paid them? And so when we paid that employee, we don't owe them anymore. So we're going to debit that salaries payable. That salaries payable is going to decline. Guess what's also going to decline? Cash, right? So we're going to credit cash, a reduction in an asset, and we're going to debit a liability, a reduction in a liability. We will always, wherever we have a debit, we'll have an equal and corresponding credit. It is idiot proof. That's why. Why do we do it? Because it's a balancing act. Total assets are always going to equal the total claims against those assets. That's the basic core of all accounting, that assets equal the claims, or total assets equal the total liabilities and total owner's equity. So total debits always equal total credits. So that's why accounting is idiot proof, because whenever you record what we call a transaction, you'll have one debit and one credit. It's equal and corresponding same amount. What does that do? That keeps assets, that keeps the accounting equation in balance, that total assets always equal total liabilities and owner's equity. We'll look at some examples of that as we go. So whenever we record a debit, we also record a credit. So this is kind of this is a place where you have to spend some time. Once you get it and understand, then once you get it, it's over. You're going to do really well in this course. So spend some time understanding how debits and credits work. So we measure with the debit, increase an asset or reduce a liability. We measure with the credit, debits and credits. But guess what? At the end, we're going to add up all the debits and credits. And for each account, we're going to be able to report, how did the business do? And we'll get a lot of examples of these. So in reporting, we have, there's 5 statements here. In this course, we will look at 3 statements. And for the first 90% of the course, all we will talk about are the income statement and the balance sheet. The cash flow statement will come later. So the income statement is all the stuff we sold, the amounts we sold to that, minus all the cost of what we sold and any expenses like salaries and other things that we incurred along the way. So the income statement answers the big question, that you're going to care about when you look at a financial statement. Is the company making money? So if revenues are much larger than the expenses, we're keeping our costs down, but we're selling stuff at a good price, that we know, hey, this business is making money. Think about Apple. They sell phones now for $1,000. I could not believe, I would ever pay $1,000 for a phone, because I'm pretty old, and I remember when we did not have cell phones. Could you imagine that? Well, that phone that Apple sells for $1,000 cost them about $600, $500 to $600. So they're making $400, $500 profit every time they sell a phone. So if you go look at their income statement, and by the way, they sell like billions of these phones, their revenues are going to be in the billions and billions of dollars, and their revenues are much higher than their expenses. Apple makes a lot of money. And so we can look at their income statement and see that. The balance sheet now is just is going to answer the second question that I talked about earlier. What's the financial status of the company? What are all the assets the company owns, and what are all the claims? What's the debt? So it's going to answer what is the company's financial situation. Cash flow statement, we'll look at the end of the course. We'll just look at cash inflows and cash outflows, and I'm not going to spend a lot of time on that. You'll see that later. And then statement of equity. Owners really care about equity, right? And we're going to show a bridge of what happened between the beginning balance of shareholders' equity and the ending balance. That's pretty interesting. And then we have footnotes that provides a lot of detailed disclosure about the financial statements. And I would say I agree, the devil is in the details, because you may see a liability or an asset on the balance sheet, and it may raise some questions for you. And you can go back in the footnotes and get more detailed information about that particular asset or liability or income statement. So here's how the income statement works. We have revenues, and then we have what we're going to look at later in the class: cost of goods sold, cost of sales. The revenues are the units we sell times the price we sell it out. Cost of sales are the units we sold times the cost of those units, and we get to gross margin. That tells us how profitable the business is on just what they're selling. But there's other expenses, SG&A, called selling, general, and administrative, that we reduce to get the operating income. We have interest, tax, but finally we get down to how much did the company make? What are the earnings of the company? That's called net income. You could say revenues plus minus expenses, a negative, equals net income. Now, if we have public companies, we might want to divide by the shares, number of common stock shares outstanding. We'll look at that later in the class, and we get to another metric that's very important called earnings per share. And that's what you'll see talked about in the Wall Street Journal and things. But mainly I want you to think about revenues minus expenses equal net income. How did the company do? And here you go. Here's a balance sheet. Notice assets on the left, they're all have a normal balance of a debit balance. And then liabilities and owner's equity on the right side, those are the claims against those assets. Again, assets, things we own, cash in the bank, accounts receivable, inventory, prepaid, property, plant, and equipment. That could be things like buildings. It also could be computer software, because a company like Amazon, one of their biggest assets, largest assets, is going to be the software they own that helps operate the cloud and whatever. And so these are all assets, or everything the company owns. Left side, debit balances. And then on the right side, credit balances are the liabilities. We talked about some of these current liabilities in long-term debt here and owner's equity. We do break this up between current and non-current liabilities. A current liability is anything that we're going to have to pay out in the next 1 year. And then we can look at that, all that we got to pay out in the next 1 year, and we can compare it to current assets. These are things that will turn into cash in the next year. So right off the bat, I can look at, if my current assets are greater than my current liabilities, then I'm probably in a good place that the company can survive for the next year and has enough cash to survive. If I have a lot more current liabilities than I have current assets, okay, right, how's this company gonna, how are they gonna survive? Where are they gonna get money? So these are things that matter. And then we can look at long-term liabilities and equity, and there's all different kind of components here of those, and we'll get through each of these in this class. It'll be very interesting for you if you're going to be a business person. Again, ultimately, total assets equal liabilities plus owner's equity. That's something everyone memorizes, but I'd ask you, don't just memorize it. Assets, things we own, left side, debit balances. Why does that, by common sense, that's going to equal all the claims against those assets must equal in total the things we own. So everything we own, left side, equals everything, all the claims against the things we own, right side. Left side, debits, right side, credits. Okay, there you go. And then we get into equity. There's two primary components of equity, paid-in capital and retained earnings. We'll see a lot of that in business later. Paid-in capital is the amount of money we receive from the owners. Typically common stock. We have this account called additional paid-in capital. You don't need to worry too much now. Later, we're going to get deep into this. Retained earnings. I would like you to think about that though for a minute here. Retained earnings equals all the earnings equals net income the company's ever made minus the dividends that have been paid out. Now, that's sitting in equity. Why? Because owners have a right to all the earnings of the company, all the net income. We go back to that income statement, going back here, that net income That's what owners, that's why they're in the game. That's why they invested in the company. They want to see a very high net income. That is theirs. And that, we will definitely have an expense to pay debt holders, interest expense, but all they get is what they originally loaned to us, and whatever that interest rate is, that's all they get. Even if the company takes off and makes it big time, we just paid back the debt that we had. However, the net income, when we make it big time, that's going to be a really high number. And our owners have a right to that. So we have this thing called retained earnings. So look at the bottom, beginning retained earnings plus net income less dividends, that equals the ending retained earnings. And so that is an important distinction. So the first thing we will do is an income statement and calculate net income. We have to do that first because we have to take that net income and we have to move it into retained earnings at the end of the year. And we'll talk about all of that. So that's Principles of Accounting, introduction, if you will. And so look forward to working with you over the remaining lectures. Again, these lectures are a supplement to whatever textbook you're using, just a little bit higher level than you would see in a textbook. So textbooks really matter when you're taking an accounting class because it's not about reading. I always say read the textbook. It's not just reading. The textbooks, all the accounting textbooks have the journal entries, and you can follow these transactions in journal entries, I would say like from cradle to grave, from the initial transaction all the way to the income statement and the balance sheet. I like a hard copy textbook so I can flip back and forth and understand how these transactions flow from the first journal entry, which is a debit and credit, all the way to the financial statements, the net in, into the net income, into the balance sheet, into the cash flow statement. And so that really matters here. So guys, thank you. I'll look forward to working with you in this class.